Ms. Cho, let's continue our conversation about the Greek crisis. David Costa, Dean at Robert Kennedy College, joining us now live from Zurich. Greek politicians were staying up well into the night trying to seal a deal before European finance ministers meet later today, but still no resolution. One of the key stumbling blocks seems to be a cut to pensions. What's your read of the situation? Do you think Greek politicians are going to arrive at a deal in time?
I think the deal will arrive, and I'm not surprised that it's taking longer than expected, and we have all these missing deadlines, because the stake is very high. The level of reform required is one time even higher. We have this 20% reduction of the minimum wage, and we are touching again pension. So in a year where we are very close to the election in April, it is not surprising that at least some of the parties have to try to wage a fight to get better conditions for this bailout. But I wouldn't see any other alternative, and I think that they will reach an agreement, perhaps with even some more conditions by the end of today. There could be, however, a surprise, delay on a decision and asking again for more time, because some of the choices asked Greece to do are really politically very difficult to take at this stage.
A request for more time wouldn't surprise anyone. The markets wouldn't. The read of the situation so far is that the far-right Laos party might be a standout here. It has some reservations, understandably, about austerity given the election. Even if the Laos party doesn't agree, do you think we can still see a conclusion with the other coalition parties?
It is certainly possible, because at the end of the day there isn't really another type of solution. There isn't really another deal that can be taken. And of course, understandably, the cuts, the type of austerity required is really at the border of social unrest to a degree. But the other way, if you think about a possible default, the consequences will be much worse, and ironically will cost to Europe more than offering perhaps a slightly more generous bailout package at this time. So there has to be a solution, and perhaps if some of the other coalition parties have enough consensus, I think ideally they will want to have, Europe would like to have a broader consensus, because the problem is if then you have a new government trying to change what was agreed before, that would be very problematic and will give again another dent to the credibility of the whole situation. So a broader deal, a broader coalition approval, but also from the opposition party, is pretty much required at this stage.
So we get a deal, but do you think there could be some helping hand from the ECB? Do you think we could get some comments from the European Central Bank on what it might do to help out the Greeks?
Well, the situation is clearly, we had this haircut taken by the private debtors, but that's really not the big part of the debt. And so we saw already an opening with this opening on Tuesday of the ECB, saying that they're going to resell or exchange the bonds that they purchased below par value, the Greek bonds. So there could be another helping hand here, and we're going to see today what the ECB is prepared to do. And that said, from what I have understood, the cards are already all on the table, and now it's up to the Greek to make a decision. I wouldn't see now, at this stage, some sort of more help. That said, even if the deal is accepted, it doesn't solve the Greek situation. So we're going to go back to the table perhaps in 6 months or a year, because the competitive issue that Greece is facing and all those cuts are certainly not going to make the situation better. So the solution is really just for the short term and not for the long term.
Yeah, indeed. So, you're not the only one saying we might be back on the drawing board with Greece, maybe 6 months, 7 months or whenever from now. But still, you've been calling for quite some time that now is the bottom to get into financials. If there are still problems with Greece, why do you think, why are you telling investors that financials are the ones to pick up at this point in time?
Well, the problems, as long as the problems exclude a default, exclude a shock in the financial markets, I see the valuation of financials very attractive based on the measure of the ECB, which are already taking effect. Of course, we had quite a bit of a rally already, so if we were buying somehow in December, up to now we are pretty much up. But I still see more upside, because I don't see a Greek default on the cards. And even if in 6 months or 12 months we're going back to the drawing board, I don't think that will impact the banks, because even now we see the market has already priced in an acceptance of the deal, and has already priced in a way the fact that this is not the last solution to the Greek problem. So given that, there is still value there, and throughout, across the boards, particularly European financials, but also on the US financials. So globally, financials have been one of the Cinderella play, and now perhaps it's time to get some benefit out of it.
Market players looking beyond just this immediate deal for Greece are looking at what austerity means across the continent. And if we just take the Greece example, for instance, Athens is now forecasting the economy to shrink by between 4 and 5% in 2012 alone. This is worse than the 2.8% predicted only a short time ago for GDP. Isn't this telling us that when you put austerity in place here in Europe, it's going to lead to a bigger contraction than expected and going to make debt positions even harder to service?
Yes, I think that's indeed what is going to happen, particularly if you have a situation like in Greece where banks are not lending, and so there is no incentive for companies to grow and to create new workplace, etc., etc. So we have a situation where the absence of a well-working financial system in a country will probably have a much stronger impact on the economy. And all these cuts, all this austerity makes sense, but without a pro-growth, strong funds to incentivize growth, companies like Greece, where wages have been increasing 33% since the introduction of the euro, as opposed to what happened in Germany, become less and less competitive. So the attraction, even from outside Greece, wealthy Greek people in Switzerland, for example, the attraction to open a company, to start a new business in Greece becomes lower and lower and lower. But that's not just applicable to Greece, it's throughout Europe. We have high unemployment also in Spain, so we need to find a way to have banks starting lending again, and the economy to start again. And so austerity alone will have a very negative effect over the mid-term and long-term, even if perhaps on the short term will keep the European governments happy.
Thank you so much for joining us today. We very much appreciate your perspective. David Costa, Dean at Robert Kennedy College. Let's get to the Europe.